Mike.
Hell no. He's been fired. Michael has been fired. He does shitty work, and we're not doing shitty work. Tune in for advice on real estate. If you have any questions about buying, if you have any questions about what the credit limits are, tune in so that we can discuss. We can discuss whatever questions you have about home ownership. When is the best time to purchase? Whatever questions you guys have, I'm here to answer any of your questions. So, whatever questions you guys have, feel free to ask me. I have a lot of people inboxing me about what the score limitations are and such. So, if you guys have any questions regarding home ownership, please be sure to ask. And I can answer whatever questions you have. Definitely is now the time to purchase and to sell. The market is hot right now. And I just wanted to make sure I answer whatever questions you guys may have about home ownership. Wanted to go over a couple tips for you guys to make sure that you knew to never, ever, ever purchase a new vehicle when you're trying to purchase a home. That is the worst thing that you can do. Establish new credit while you're purchasing or attempting to purchase a home. If you have any attempts to purchase a home within the next year, do not go and purchase a vehicle. That is absolute home ownership suicide. That's one of the major tips that I can give. And to save, your credit scores does matter when it comes down to what your interest rate will be. And if you qualify for down payment assistance, which is your first time home buyer programs that they have. So if anyone have any questions, please chime in and ask me regarding home ownership. I'll even answer some questions about credit if you guys have some of those as well. But I'm only going to be on here a few minutes, so I wanted to touch bases with you guys to see and answer any questions that you guys may have. You can also ask me about credit as well if you're wanting to know tips on how to increase. And also I wanted to touch bases on also a lot of people that are in my credit program. Sometimes they read and sometimes they don't, but thanks, Adrian, congratulations. And so sometimes they read and sometimes they don't, but here's what I want everyone to know. When you're in a credit program, I only offer credit restoration. I do not offer credit building, and I never advertise that I do. The first thing for you to restore your credit is to dispute all of the derogatory accounts that are on the credit report. You cannot build successfully without doing so. So credit restoration should always be first. And most times people think that because they can add a trade line on their credit report, their scores will increase. But honestly, even if you have a 760 credit score on a trade line, someone added a trade line on there, you do not qualify to buy a house. That's just simple. They will not tell you that because most people don't know. But just because somebody added you on a trade line and your credit score increased to a 750 and you have no open accounts, you do not qualify to purchase a home. It doesn't work that way. That is considered borrowed credit. And although the numbers are going to be excessively high, that does not mean your credit report is strong. I have some people that has a 520 and their credit report is stronger than someone that has an 800 credit report. So it just depends on what you're trying to do. So I just want to clear up all the rumors and all of the I heard and does this and did that. It doesn't work that way. In order to purchase a home, you must have at least 2 to 3 accounts that are actively open and you're actively paying monthly bills on their active accounts. Now, I've had a couple of people in my program that get in the program and expect to get a 700 score when they have 50 derogatory accounts, nothing positive. Let me just be clear about something, you guys, and just please hear me if you don't hear anything else that I say. Please understand this. Credit is based off of how you pay your bills. If you pay them on time, if you pay over the limit, if you pay under the limit, if you pay over what the monthly payment is. Credit is based off of how you pay your monthly bills on time. And it just baffles me for people to think that you're going to have a 700 credit score if you have nothing but derogatory accounts. Even if every single account came off the account and came off the report, you will not have a 700 credit score because you have nothing that you're actively paying on a monthly basis. Remember that. So anytime that you're being unrealistic and having unrealistic expectations, you're only going to hurt yourself and you're only going to irritate yourself and make yourself upset. And that's one of the things that I did want to explain. A lot of people assume, because there are a lot of people that give false hope, that do credit restoration or credit repair. There's a lot of people that get into these programs and they assume that they're going to be able to go purchase a $100,000 car and whatever kind of house they're wanting. Let me be clear about something. Your credit score does not determine how much house you qualify for. Okay. The only thing that determines what you qualify for numerical wise is your income versus your debt, which is called your debt to income ratio. So if you go and purchase a car, then that's going to affect how much your approval rate is, because now you have added additional debt to your credit report, which now lowers the amount of house you qualify for. So I don't know who is telling you guys that, but please understand that from a financial advisor and a credit specialist and a realtor, I'm letting you know up front that it is imperative to the most important thing is to pay off debt, not to accumulate more debt. That is absolutely absurd to go and purchase new debt and apply for new debt if you're trying to purchase a home. And another major issue that I want us to across, since we're coming upon the tax season, I am a senior tax specialist, have been for 7 years. And I just wanted you guys to know another thing. I have a lot of clients who work very hard, make the money, have the credit scores, but they cannot purchase a house because their tax preparer has written all of their income off. You cannot expect to purchase a house if you made $100,000 a year and you allow your tax preparer to put a Schedule C self-employed debt on your tax return. Please be careful how you claim your taxes, okay? It's time out for that. There has been a lot of people that have been doing this for many years and they're very comfortable, but let me tell you this. What was accepted by the IRS years ago will no longer be. Do not allow a tax preparer to put a Schedule C or any self-employment debt on your tax return. That will hurt you. And another very, very important issue that I see, I've had 3 deals fall apart at the closing table because of student loans. Let me tell you this, guys, and please listen to me when I tell you this. To put your student loans in deferment, it is only $5, $10, $15, no more than $20 a month. You have to stay upon that stuff. All you have to do is call your student loan company, put it in deferment. You will not be able to purchase a home on a federal loan, like a FHA, VA, USDA. You will not be able to purchase a home if your student loans are not in order. Now, I'm not saying set it up to where you're paying $500 a month, but if you have student loans and they're deleted off your credit report, I've seen this happen many times. They go apply thinking because it's off of their credit report that it's not going to come up. There's what you call a Kivers number. And a Kivers number is pulled every single time a lender goes to order your appraisal or to ask for a clear to close on your file. During these times, I will most certainly tell you that even if it's not on your credit report, it will report on this Kivers report, and it will cause you your debt to income ratio to be increased and you not to be able to purchase a home even a week before closing. So please be knowledgeable about that. Tanya, what advice did you give about down payment and closing costs? So basically that also varies upon your credit scores. So if you have a 640 or higher, you possibly could qualify for down payment assistance. However, your debt to income ratio matters. For all of the down payment assistance programs, they do require you to have a 46 or 47% a 47% debt to income ratio. So if your debt to income ratio is high, you can have a 760 and it doesn't matter. There are income restraints as well. So if you make over a certain amount of money, if you're a couple and you're trying to apply on the loan together, both of your incomes will combine, and if you're over a 76,000 or 78,000, I don't know the exact numbers offhand, but you do not qualify for down payment assistance. So there's multiple ones. You have a city down payment assistance program, you have a county down payment assistance program, and there's also loans that can go up to 97%, 96.5, which is FHA, and then you have some VA. All VA loans are 100%, meaning you bring no money down, but you may still have to pay your closing costs. So those are the two things that I will honestly say. Every last one of my clients, before I allow them to put an offer on a property, I always advise them and let them know up front possibly what their closing costs will be. So let's just say your house is $200,000, right? So if you have a FHA loan, that means you have a 96.5% loan. So FHA is only going to loan you 96.5%, which means you have to bring 3.5% of the sales price to closing only for down payment. Not to mention, in this market, no one is basically paying closing costs unless it's a property and they have been on the market for a minute and they just want to get rid of it. In that event, they will. But I have had a situation where I had a client approved. We found a property, went under contract. The home did not appraise for what we offer for it, and they backed out of the deal, which they have the right to. So there's a lot of different things that having your own closing costs will eliminate you from going through. Home ownership is amazing. This is the perfect time to purchase. And I will honestly say these rates are extremely low, and I've never seen anything like it. The rates are even a 2.6, 2.7, 3.2, depending on what kind of loan you have. There are also some other programs that you can get into. You only need a 640 credit score for that or higher, and it's 100% loan, but the rates are higher. So just know that when you're in the process of trying to purchase a home, there's a lot of different things that go into it all goes together as far as exactly what you're trying to do and what you need to make sure you have together. So the rumor number one that I hear a lot about is if you have a 640 credit score, you automatically qualify for down payment assistance, and that's the furthest from the truth. There's a lot of things that go into qualifying for a down payment assistance program, and one of which is having a low debt to income ratio. Student loans are factored into your DTI. So what that means is if you have $50,000 in student loans, they will factor in 1% of that, which is a $500 payment. So if you have $100,000 in student loans, the lender must factor in 1% of that, which is $1,000 a month. So they have to factor that $1,000 a month into your income and as debt. So unfortunately, student loans have to be factored into your DTI because of the amount of student loans that you have. So that is a concern. Now there are some lenders that can use your monthly note if you have them consolidated, which possibly you could, but you have to be in a good standing. So you need to get those student loans out of default right now. Make a payment of $5 or $10, $25 consistently for at least 9 months, and you will not have an issue trying to purchase. But you must stay upon those student loans because it's very detrimental when you're trying to purchase the home. And Pia, would you recommend putting a down payment of $25,000 on a house? The only time that I would recommend putting that kind of money down on a property is if you're trying to buy down points. But other than that, it's not necessary. $25,000 will probably have your note maybe $100 lower. So that makes no sense to bring that kind of money up front. And I will tell anybody, the only reason why I put down the bulk of money that I put down on mine because my home was over the limitation for FHA. So I had to bring the difference down. For example, if the cap is $270 and your house is $300, then you have to bring the other $300,000 because FHA will only give you $270 on the loan for FHA loan. So that is the reason, the only time, that I would recommend putting that kind of money down on a property, or if it's an investment property. But again, each person have different reasonings why they put money down or why they want to buy points down. It's totally up to you. Either way, it wouldn't make or break a deal on how much you bring down. Now, if you're doing a conventional loan with a 95% loan, then you have 5% down payment to bring. So that's very important for you to know what kind of loan you have. I have several people that come to me saying they're pre-approved and they absolutely have no idea what kind of loan they have, which means if you don't know what kind of loan you have, you don't know what kind of money you have to bring to the table. And I've seen several people at closing, not my clients, but I've seen people call me devastated because when it came down to closing day, their realtor nor the lender advised them of how much they had to bring to closing until 2 days before closing. And that's detrimental. So you need to always ask, if you have a loan, and if it's a conventional loan, then on a conventional loan, you can do 97%, which brings you 3%. You have a 95% one. You have an 80% one. And whatever the percentage of the loan is, that the other amount is what you have to bring to the table out of pocket for down payment. So example, if the loan is $200,000 and you have a conventional loan for 95%, you have to bring 5% of $200,000. So that's basically how that works. And it's nothing that you can call. You can't call someone and say, hey, how much do I need to put down on the house? Well, that will determine how much the property is, because the down payment is always going to be a percentage of the price of the home, of the list price or sales price. So I need to start paying something towards my student loan instead. No, Keisha, I'm not saying that. What I'm saying is, if your student loans are in default, you need to call and get them back in deferment. Okay, so let's talk about default and deferment. Deferment means that they're deferred, basically. Default means that you have not set up a payment plan. You have not put them in deferment. You basically just said screw them, and you're not going to do anything with them. So you definitely need to do something with them. Get them in deferment or forbearance. So the two things that you can do are both of those, and start making consistent payments. Because right now, if you have not paid them and you set up a payment plan, then they will go into collections. And once they're in collections, you have to pay them off in full or make a settlement. So please, guys, go ahead and call and get them in deferment and set up a payment plan. So if you're looking to buy next year, all you would have to do is make those 5 or 6 consistent payments, maybe even 9, and then that way your student loans will be back in deferment. What if you are currently enrolled in school? Can you still set up payment? Latrice, if you are currently in school, you should already be deferred. I don't know exactly how that works or who your lender is as far as your student loans, but you have several. Mine is Fed loans, but they have a lot of different ones. For Fed loan, I have mine. I pay $25 a month, and I'm almost done paying them off because I graduated in 2012. But that's totally different. If you're currently in school, they should already be in forbearance, and they should stay in forbearance until you either graduate or get another job, if I'm not mistaken. But it depends on the student loan company that you're through, so you might want to reach out to them and ask them whatever questions you have regarding that. Thank you. We've been in the Yes. So, okay. So the thing that I will say is what I've come across a lot. Hey, Key. I have come across a lot of people talking to other people saying, well, my friend did this, and why do I have to bring this, and why do I have to bring that? Well, it's a lot of things that you should already ask before you start your search. And one of which is making sure your student loans are in order, not paying $500 a month, not being real. That's not realistic. But you do need to put them in deferment, because running from your student loans will hinder you from purchasing a home. I can tell you that right now. I just witnessed a client lose her entire deal because of that. Jaren, so what's the minimum requirement for becoming a homeowner as far as like credit score and income? So again, Jaren, credit scores basically, you can purchase a home at 580, okay? But with a 580 credit score, you must have reserves, meaning you must have money in the bank to show that you're stable, okay? Or you can have a 620 and qualify, but if you have a 620, you do not qualify for down payment assistance. 640, you qualify. That's one of the qualifying factors for down payment assistance. However, you must have a low debt to income ratio. So again, is all based off of your debt to income ratio and your credit scores, whether you're qualified for down payment assistance. And 99.9% of the ones that I'm aware of, you have to have at least a 640 credit score, median credit score. So you have 3 different credit scores. You have Equifax, TransUnion, and Experian. So out of these 3, you throw out the highest score, you throw out the lowest score, and whatever score is left is your median, MEDIAN. The median score is the score that all lenders will use on your mortgage scoring. So most people think that you can throw a trade line on somebody's credit report, and because you have a 700 credit score now, you can purchase a home, and that is totally not true. That is a rumor. That is false. Mortgage companies, they run all of their approvals through a system, and in the system can recognize authorized user accounts. They know because they're coded. If you look on your credit report, it will say authorized user. Mortgage companies does not give you credit as Credit Karma does, or Identity IQ, or any other credit monitoring service. They do not give you the credit as they would, because the scoring methods are different. Each lender have different scoring systems. So when they put the information in the system, it's going to score you according to your active accounts that belong to you. You can't use piggyback credit when purchasing a house. You may can for a car, you may can for another credit card or a line of credit, or for limited credit, but you cannot purchase a home on borrowed credit. It's not going to happen. So, yeah, Gilbert, it's frustrating, and it's I don't like the fact that a lot of to purchase homes because they don't know. How early should you start the process of getting credit in order if you want to purchase in 2 years? Pia, you're doing the perfect thing. So first thing first, if you have credit that needs restoration, you need to do credit restoration. You can do it yourself, or you can hire a professional, either one. If you have the time and the patience, then most certainly you can do it yourself. But just please understand that if you start sending letters off for yourself, and these letters are not accurate and they're not the right verbiage on them, you will affect your credit report, because they will lock your credit report up. So keep that in mind. But it's definitely something you could do yourself if you have the time and if you have the patience for it. Now, so answer your question, Pia, in 2 years, what I would do right now is what you're doing, getting your credit restored. Once you do the credit restoration, we graduate to building. So most times people need to build credit because all the credit that they have is all derogatory. In that event, you will contact your local bank, whoever you bank with, because you have a relationship with them. Ask them, do they have a credit building program? I know Bank of America does. I know First South does. Most credit unions do as well. Navy Federal. It's other banks that have. You just call your bank and ask them, do they have a credit building program? Because most banks do, especially if you're already a member of the bank, then they will give you this. So basically what I recommend doing is say, for instance, you have 20 derogatory accounts. Okay. If you add a trade line on top of 20 derogatory accounts, you are not going to see the results that you possibly could see if you don't do that. Yes, Ronnie, Bank of America does. But you don't need it because you good. You don't need it. But I'm just saying for people who don't have. And Gab, Orion, I think, does. Most credit unions do. And I think Orion is a credit union. Now, I definitely always recommend credit unions. Nothing against big banks, but credit unions are more personable and they offer you more, and they're more lenient when it comes down to personal accounts. Like for my business accounts, I go through Regions or a bigger company like Pinnacle. But for personal, I most certainly always recommend trying to build your credit through a credit union, because they're more lenient and they're more open to, they're not as strict as bigger banks are. So the first steps will be, if you have credit that has been tainted, you definitely want to go ahead and get credit restoration. Whether it's through yourself, you find a family friend or someone that can show you how to do it. Now if you already have good credit. So say, for instance, myself, my son is 22. He's 22 years old. When he was 17, I added him on a trade line for me. Now, this is being properly prepared. I added my son on a trade line when he was 17. 30 days later, he had a 760 credit score. At that moment, I applied for him 3 different credit cards. He has an American Express. He had an American Express, a Chase card, and a Delta American Express Sky Miles. So he had those 3 cards. I used them and paid him. For over a year or 2. He's still at a 760, but he has credit, real credit, in that, not borrowed credit. So that's basically what I mean by piggybacking. Piggybacking can help you build your credit, but it's not going to be instant. Not to purchase a home. So basically you would just start off. So mothers, fathers, aunties, whatever, if you have teenage children in your family and you have excellent credit or decent credit, add them on your credit card as an authorized user. Do not give them a card, but add them as an authorized user on your account. It's going to automatically increase their scores. This I know for a fact. And then once they do that, then you apply for them a credit card in their own name, and you use it and pay it. Keep the utilization under 30%. So if that is the case, over the next year or 2, If they have the income, they can purchase a home. Right now, if my son if he wanted to go purchase a whole house, he can, because he has credit of his own and he's not an authorized user on my accounts anymore. So that's kind of the beginning of how you do that. But it's not a quick fix. That's definitely not going to happen. So if you have teenage kids, make sure you break these generational curses, because it is haunting. It is definitely haunting. My mom had the same issue. I came in, I cleared her whole entire account and completely cleaned it. Now she's at a 722, 740. I posted it last week of her scores. But yeah, Pia, so you're doing the perfect thing. So once you get established and you get your credit built, you can add your husband and your son as well. But just remember, it's important that you clear off the derogatory before you try to build, okay? Because you don't want to build unless it's solid ground. Then that makes no sense at all. So income limits does not matter. It just depends on how much you want to get approved for. So if you make $100,000, but you have a $1,000 car note, you got 30 credit cards and they're all high, you might still qualify for $200,000. And that's very minimal in this market right now. You really can't find much for $200,000 without being in a multiple offer situation. So it's all basically it's based off of how much debt you have. That's one thing. Now, your credit scores is going to base your interest rate. Now, that will make a difference in your interest rate, but it's not going to make a difference in how much you qualify for, as far as, what your pre-approval amount is for. So always remember that, because that's another rumor and a myth that I hear. I want to wait till my scores get to a 750 so I can qualify for more. You will not qualify for more. The only thing that it will help you with is your interest rate. That's all that'll help you with. So there's no sense in you trying to increase your credit scores to a certain limit, a certain amount, if you're trying to get more money, because it doesn't work that way. Oh, okay, Pia. So again, I don't like anybody to have any misconceptions about credit restoration, because it is exactly what it's called, credit restoration. You're restoring your credit. And with that being said, you have to restore to rebuild. That's just it. You can't apply for credit if you have 20 different collections on your account. So it's always better to build on solid ground, to build with a clean surface and a better ground to build on. So that's certainly something that you have to think about when you're talking about purchasing a home. And they will come up in the report when you get your credit pulled. They could factor that in, and they may make you pay some collections off. It just depends on the lender and their requirements. Another myth that I've always heard, people come to me and say, well, my mom purchased a house back in the market as of 2020. Is completely different from anything prior to. This is our new normal, and we have to get accustomed to it. It is very unfortunate, but it's very fortunate and unfortunate, because it's the perfect time to purchase a home, but it's the perfect time to sell a home as well. So it depends on what side you're on. It's definitely a seller's market. So if you're looking to sell your home, this is definitely the time to do so. Well, there's other big qualifications. So Gabrielle, your credit score is the number one qualification, at least a 640, because with a 640, you will get more than likely you will get a automatic approval. But it is also 2 years of tax returns. You have to have the 2019 and 2018 tax returns along with your W-2s attached. And you have to have your check stub. So you have to have a consistent income for 2 years. And so when you're purchasing a home, you cannot apply for any new credit. So it's super simple. You have 2 years of tax returns with W-2s, at least a 640 credit score if you want to attempt to qualify for down payment assistance, and that's basically it. And most times you will not need much. If you want to save about $8,000. Just save enough for your closing costs if you have a 640 or higher, because there are some programs that are 100%, meaning the loan is 100%, so you have no down payment. But here we are with this closing costs, because now no sellers are having to pay closing costs, because they're having 10 or 15 different offers on the houses. Okay, so that's good. You work on your credit score and you'll have everything else you need. But like I said, you guys, it is imperative to get your affairs in order. Student loans are not going to go away. They're not going to go away. So just give them $20 a month, get it set up, and be current on there. Most people that I see, 90% of my clients, they have about 40 points lost because of student loans. And anybody that has student loans have multiple. I've never seen a report that only had one set of student loans on there. It had to be 2 or 20. Get those in order, and it'll improve your scores too, because the student loans report as paid as agreed, whether you're paying it or whether they're deferred. So when it says paid as agreed, you certainly wouldn't have to worry about having a derogatory mark on your account every month, because every month is going to report derogatory. And if you don't keep them in deferment, once one report late, it's going to report late on every student loan you have, dropping your scores down over 100 points. So that's something to keep in mind. When you are married and one has a good credit and the other one doesn't, how does that work? Or how does it work for two people applying? So Tanya, whoever is on the credit application have to have these requirements. So if the husband is the one with the good credit and the wife is not, you cannot be on that loan unless you qualify. Okay, so you can't have both on the loan and one have good credit and you're using the other's income. If the income is used 90% of the time, unless it's a whole nother kind of conventional loan, but 90% of the time, if you're on that loan, you must have qualifying scores and you must have the income to prove as well. You have to have all qualifications to be on the loan. So that I know for a fact. So if I would recommend either getting the scores up if you're wanting to use the income of the second spouse, or just put it in the spouse's name and you can be on the deed. So for example, if it's me and Corey, and Corey's scores may be 500, he can't get on it, but I want to use his income. What I would do, I want his name to be on the deed as well, of course, but he ain't got no bad credit, so I ain't going for that. But if I get the mortgage in my name, the actual mortgage, we both will be on the deed. So you can still be on the deed, but not on the mortgage loan, if that makes any sense. You will still have ownership of the property, but you would not be responsible for the loan. And that's a good thing, because maybe at some point you want to do an investment property, you can get it in the other's name and it won't be on both debt. You can hear that from me. So that's an option. You're welcome. Let's see. I'll bow to my steps and never be in a situation ever again. Pia, we all make mistakes, baby. Ain't no sense in you fretting on that. It is what it is, but it's all about you trying to do better than you are. So that's what I keep the focus on that. Do you by chance know when the market shifts to a buyer's market? Latricia, honestly, this is our new normal. The only way I don't see a market crash coming anytime soon, because the market is too potent right now. What I would think though, and that's another thing that I wanted to touch bases on. If you are a homeowner currently, if you do not need it, if you have a job, do not get the assistance for your mortgage. They are going to report it late. That's just that. You are going to report late. I have had several clients in the process of selling their home and found out they had a modification done. Do not do a modification if you do not desirely need it. If you desperately need a modification, you lost your job and it's needed, absolutely. But do not do modifications if you do not need it. If you're still working, do not do modification, because it's going to report late. On a contract, when you signed for your house, you signed up with the mortgage company that you were going to make this payment on this particular day. If for whatever reason that contract is breached, it is not paid as agreed, therefore they're going to report it late. They're not going to tell you that, but they are going to report it late on a car loan as well. So keep that in mind when you're applying for this relief and you really don't need it. Now, I do foresee in the future, this is my personal opinion, I do see how people are getting this relief on this mortgages, and you get it for 3 or 4 months. Your mortgage is $1,000, and then the 5th month they're asking for $4,000 plus the 5th month. Now, if I didn't have $1,000 to pay you, how am I going to give you $5,000 plus back interest and everything else? So be careful and ask all the kind of questions to get it in writing, because I've seen people that apply for the modification and they ask will it be a late payment, and now they have 4 or 5 late payments on their report, and they can't remove them because they are late. I had a lender on my credit today. He said my middle it's called median, but yeah, it's the middle score. It's 550. Will getting my credit restored get me to where I need to be? Erica, I can't answer that without seeing a credit report, because, again, I don't know if you have accounts that are late. I don't know if you have all derogatory, if you have any accounts that are active. But I will say this. A lot of times when people are going to purchase, apply for a home loan, your credit utilization is out of whack. So if you have 4 credit cards and all 4 of your credit cards are over utilization, you're losing over 100 points. My clients can vouch for that. Every time I check the report, I always call my client and say, hey, you over 30% utilization. You need to pay that card down. prime example, if your limit is $500, this is how you do the estimation of it. So if your credit card, if your limit is $500, if your limit on your credit card is $500, and 30% of that, 30% of $500, I think it's $125. Anyway, this is how you do it. You take your limit and you multiply it by 30%. I think this is what it is. I think, no, it's $150, but I always say pay it down to $125. So yeah, running. Let me get you. But you take your limit, you look at your credit card, and if your limit is $700, you do $700 times 30%. And whatever that amount is, that balance should never go over. And the moment that that balance goes over that amount, you will, if that balance goes over that amount, your scores will drop. And it's going to drop monthly until that balance is paid down under 30%. Keep that in mind, because that's one of the major things that I see on a daily basis. You're welcome, E. Okay, so Tanya, what if you have bankruptcies and they are dismissed? It depends on which one you have. A Chapter 7, you cannot purchase a house with a Chapter 7 until you're out of it for 2 years and it's dismissed. And you still have to get, no, you don't, for Chapter 7. So Chapter 7, you have to be out of the bankruptcy. It has to be discharged for at least 2 years before you can purchase. Now, a Chapter 13, you're able to purchase while you're actively under a Chapter 13, depending on your credit scores and everything else. But I do know that with a Chapter 13, you can't be late. You can't have any late payments within that time you've been in a Chapter 13 or the time you've been out of a Chapter 13. But you can purchase a home while you're actively under a Chapter 13, but you have to get permission from the courts, if that makes any sense. You have to get permission from the courts to get to purchase under Chapter 13. But 7, no, you can't until 2 years. If you are still attending student loan office will not give you anything stating you are deferred because you are still current money and it shows on your credit report as a high debt ratio. Latricia, that is a question for a lender because they have different things that they can do. I know Dietrich Robinson and Tamara Salisbury, they both have methods of ways around that. I don't know it's particularly because that's not something I do as a realtor, but I do know that those two I've worked closely with before, and they both have different things that you can do to get those situated and get a letter or something of some sort from the credit, from the student loan people. What if you pay it down when go over the 30% before the billing period ends? Would it still? Yes, Lawana. So my advice to you is what I tell all my credit clients. Her question is, what if you pay it down when go over the 30 before the billing period ends? So I advise you to make your payments on the statement date, not the closing date. Okay, so basically not on the due date, but on the closing date. I mean, the statement date. Statement date is the actual date that it reports to the bureaus. So if you have credit cards, call your credit card company and ask them, when do they report your payments to the bureaus? Because the biggest misconception is a lot of people will go over the utilization and they pay it down and use it again a week later. The issue with that is the creditors, okay, let's just say Capital One, for example. Capital One reports to the credit bureaus once a month. And when they report that balance once a month, you could have been used it, paid it. But when it reports to the bureaus on the statement date, it's going to report the higher balance because that's what the balance is when it reports. It doesn't matter how many times you pay it throughout the month. So I always recommend on the credit cards, keep that balance under 30% at all times, and always make your payment, make at least a $25 payment over what your balance is. If you can pay it off, fine, but if not, always leave a $25 or $30 balance on the cards. That will assist you with your credit scores, but I can guarantee you, if you have multiple credit cards and you're always saying, I don't understand why my credit won't go up. I don't understand why I'm stuck at a 660. I can't move. It's because you're not doing right by those cards. So you certainly need to make sure that the utilization on those cards are paid down 30%. You do that, I guarantee you will see about a 50-point increase easily, because credit utilization is 30% of your credit score. That's a lot. When you out of 100%, that's 30%. Late payments are 35%, and the mixture of credit is 10. So mixture of credit, your credit utilization is 30%. That's almost up there with a late payment. So if your score is affected, you miss one payment, your score drop 100 points. Imagine what your score would drop if you're over utilization. So just try it. Go and do a whole inventory over every card that you have. Look at what your balance is right now, and then do your 30% utilization. So if it's $500 times 30%, that's $150. So pay that card down to $149. You will see and keep it at $149. Don't pay it down and then turn around and use it. So if you pay it down under 30% utilization, again, example, if you have a $500 limit, 30% of that is $150. If you pay the credit card down under $150, $149, you don't have to pay it all the way off. Go through the inventory on your credit cards and see which one it costs the least to pay down. If it's something that's $300 or $400, pay it down, sit back 30, 45 days, watch how your scores are going to increase. A lot of people who have lower scores, they actually qualify they qualify to purchase a home, but they don't know it because of that high debt. So just keep those balances down, you guys, and I promise you, if you're at a 580, 585, you pay 2 of those cards down, you will jump up to a 640 easily. That's something a lot of you guys don't know, but those credit cards are going to make a break. So especially when you have lower limits. So if you have a credit card that has a $300 limit, 30% of that is $90. So as soon as you can fill up your car and be overutilization. So it's always important to pay those cards down before they report to the bureaus. So this lesson from this is call your credit card companies, all of the vendors, ask them when do they report to the bureaus. They the bureaus. What you would basically do is make your payment on the statement date. So when it actually reports to the bureau, it's not going to report the balance as the due date. It will report the balance as of after you made your payment. That way you will always keep a low balance on your credit report. Now, I don't know if a lot of you noticed this, but have any of you guys ever had a credit card and you look on there and they done reduce your limit? You used to be $1,000. Now your limit they done dropped it to $750. Well, that's the reason why they do that, because you are a liability. When you have 4 or 5 different credit cards and all of your credit cards are overutilization and they're near what the limit is, they will reduce your limit because they're afraid that you are going to go into default. That's one of the reasons why you must always keep your utilization low, because if not, you are going to be a threat to the credit bureaus. So that's one of the things that you always keep in mind as well. And I know a lot of you guys have credit cards and you have went over the utilization and some even over the limit. So if you have a limit of $1,000 and your balance is $1,056, that tells me one thing: you are making minimal payments, but you're constantly using the card. So that's basically what that means, in my opinion. So if you have a $1,000 credit card and your balance is $1,056, 90% of the people are gonna say, "Well, I'll never be able to pay this down. Let me go ahead and just, charge it as collection and stop paying it." So the credit vendors know that. So that's why they're gonna say, "Well, let me go ahead and drop this limit now." So they can't come back and try to use all this limit up and then try to, do a charge off or collection and stop paying it. So it's easy to get caught up in debt, but not if you keep those balances down. If you be realistic about your purchase, if you can't buy 3 times, you can't afford it, and it have to keep those balances low. Keep them under utilization. You will see all of your scores. You will make sure that your limits are going to, and that's another thing. If you have 4 credit cards and if you wonder why no one ever gives you a limit over $500, well, that's why. Because when they pull your credit, they see that you rely too much on your credit, and that is a liability. So it's a lot of different things that all of my limits are high because I have over $380,000 in credit cards available credit. I do not access it. Okay, so as a vendor, as a creditor, they're looking at how much money do you have access to that you have not used. That's the goal. Having a $5,000 credit limit is not the goal. Having a $5,000 credit limit and a $4,500 available credit is the goal. That's what allows people to give you more credit when you apply. So if they look at your report and say, okay, well, she has $380,000 worth of available credit, and her limits on it is $20,000, over $400,000. They're going to give me a $20,000 credit because they see that I have cash assets. I have to in order to keep up with this kind of, credit. So, which I do, so I don't go swiping my card if I don't have to. That's not what credit is for. Regardless of what people hear and what you see, this is Memphis, and I understand you got a lot of people, they think that you get a good credit score, you're supposed to go buy a car. Y'all know I don't rock like that. So in my personal opinion is, if you have great personal credit, you can go buy anything you want and they'll throw money at you. I know this for a fact. living it in as we speak. If you have good personal credit, you can walk into a bank right now and ask for a $200,000 business credit loan, and they will give it to you on the strength of your name with no check, no bank statements, no tax returns or anything, because your credit profile is strong. So it's not about how much money you make. It's not about any of that. That makes no. If you ever apply for a credit card, they ask you what your income is. They never ask you for proof, because it doesn't matter. What matters is, I have a $55,000 credit card right now with a zero balance. That's why I'm able to go purchase whatever I want to purchase with low interest rates or whatever, because I don't rely too much on my credit. Now, if anything ever happens to me, God forbid, anything happens to my fiance, we gonna be good. My sister, my family, I always make sure that I'm good when it comes down to credit. When it comes down to me getting approved for anything, there's nothing I can't go apply for right now. That does not mean I'm going to go apply for everything. So that's one of the things, exactly, going for a strong credit profile. Your credit score means absolutely nothing. Mine is a 762 right now. And there are some people I know with an 850 credit score. I've seen people with an 850 credit score and can't buy a pickle. So don't get too caught up on scores. That's what you do not do. Do not get too caught up on credit scores, because a credit profile with a 660 can be way stronger. So if you have a credit profile that has a mortgage loan, a car loan, 2 credit cards, a line of credit, all zero balances, you're going to have about a 760 like me, because I have a lot on my credit. And if you think that these creditors do not pull your credit on a monthly basis to check in on you, you are sadly mistaken. It's called a soft pull. That's the reason why when you get these, when your rates, when your balance, your limits are dropped, they drop those limits because they've checked in on you and see that you're close to your limit. And they go in and see that you have 10 credit cards. And on all 10 credit cards, you are $100 over the limit. You are a bankruptcy risk. So immediately they're going to reduce your limits. I know for a fact at least half of the people on my live right now have experienced limit drops. And that's why, because you are relying too much on your credit. And if you're relying too much on your credit, you are a liability, and they're going to go ahead and nip that in the bud before it gets out of hand. That's why. So there is no sense in you having 10 credit cards and none of them over a $500 limit. That makes absolutely no sense whatsoever. But when you know better, you do better. So if you keep those balances down every time they see, okay, well, she has a $500 limit and she has a zero balance, they would be more comfortable loaning you another $1,000 when you do an increase. But the reason why you do not qualify and you never get approved for credit line increases is because you abuse the credit limit that you currently have. That's a raw reality. And I'm telling you this because I know, because I tested it with my son's credit cards. So everything that I advise you guys of and I post on a daily basis, these are things that I actually have done and tried to make sure I know what I'm talking about, because I don't want to be he say, she said, or I read here, I read there, which is great. But I have experienced this on my own because I have done a test and a trial with my son's, myself, or my mom's credit, to where I know for a fact this is happening. For instance, my son, he has about 8 credit cards right now. They're all zero balances. Now, I do use them. But one thing about a credit utilization is you can always fix it. You cannot fix late payments. So if you have a credit card and your balance is, your limit is, your monthly payment is $25, help me understand why you're missing those payments. All you have to do is set up automatic payment. There is absolutely no reason for you to ruin your credit report, because late payments stay on your credit report for 2 years. There is no option. There's no way around it. Late payments affect your credit report, your credit scores, for 2 entire years. So if all you have to do is set up automated payment, even if it's for the medium. So if you have a $25 minimal payment, you can always just set up automated payment for $25 a month. That way you can pay extra if you remember, but if not, at least you paid the minimum. They can't report you late. So that's what I just wanted to touch base with you guys on. Let's do better. Let's be better. It is 2020. This year has been chaotic, but it has completely been amazing for me. I can honestly say that I have not experienced all of the roughness and the rough patches that you guys have. And I pray for you guys, and I just hope that everything works out for you. But I will say this: credit rules the nation, but you have to know what that means. Having a high credit score is not what life is about. Credit scores mean absolutely nothing when you have a weak credit profile. You can have a 650 and credit profile be way stronger than someone with an 850. So do not let nobody get you caught up in buying trade lines that you can't do nothing with. A trade line is somebody adding you as an authorized user. That's what that means. So if you're going to pay somebody $2,000-$3,000 for a trade line, ask your cousin, your father, your mother, your significant other. Ask someone that is in your circle. Can they add you as an authorized user? Do not request a card. Watch your scores increase, and then you can build from there. Love you guys. I just had a contractor walk in. I have to go, and let's get you in these houses.